Welcome to the SOP Advisors webinar. Just getting started. My name is Steve Allen. I'm the Managing Director and Portfolio Manager at SOP Advisors. Joining me on the webinar is Darren Geiger, advisor to the firm and someone with decades of energy and commodity experience. The webinar is a third in a series, all of which support our thesis that hard assets will outperform paper assets in the coming years. In short, stuff will outperform paper. In fact, it's in our name, SOP, stuff over papers. Replays of our inaugural webinar, which lays out our reasoning, can be accessed on our YouTube channel and on our website. As we look out how our thesis has played out, and it has played out well, some are questioning whether all the returns have already been generated. How much better can it get? We believe that it can and will continue to play out for the foreseeable future. Darren will now get us started on just how well things have progressed.
Thank you, Steve. Commodities and real assets have found their way into headlines a lot more over the past 12 to 18 months, initially due to the large price run-ups in gold, silver, platinum, as well as copper. However, more recently, that's shifted over to oil and the energy complex. However, that isn't just about recent performance. We're seeing a fundamental shift in how global markets value physical assets now. This is driven by wars, tariffs, geopolitical realignment, electrification, including grid transmission upgrades, and inflation dynamics that just aren't going away. This chart that you see now is the Bloomberg Commodity Index, and it just shows how dramatic the move's been over the past year, whereby we've reached the last peak during 2022, which was the onset of the Ukraine war. This performance is despite a fairly sizable move lower of late in precious metals since the start of the Iran conflict about a month ago. Obviously, that has been offset by numerous energy product gains, primarily oil and other liquid products such as gasoline, diesel, jet fuel, etc. The next chart shows the performance of specific commodities, or more specifically, their futures contract performance year to date. And as you can clearly see, the performance is not isolated to just one or two commodities, but is becoming much more broad-based, which ties into our general thesis. Given the dynamics more recently with Iran, energy-related commodities and products have temporarily taken the lead. However, there are many agricultural and metals-related commodities on the list that are performing quite well. This list also doesn't represent all commodities. Products such as chemicals and fertilizers that we have exposure to are just not represented here. And many of these have extended year-to-date gains as a result of the logistical issues related to the blockage at the Strait of Hormuz. And we'll get into that on this next chart. It depicts how much of a problem this has become and provides some context in terms of the logistical nightmare in the Strait. What was 120 plus ships and or tankers crossing the Strait per day has trickled down to no more than 5 to 10. And again, this isn't just oil and LNG, but this includes bulk carriers, container ships laden with all sorts of commodities and products. Now that talks have broken down over the weekend between the US and Iran, this likely won't get any better, at least in the near term. This next chart more specifically digs into fuel products and fertilizer, and shows how dramatic the price increases have been over the past month or so. It's become to the point where there are regional shortages and fuel rationing going on with respect to diesel and jet fuel at this point. And on the right, urea is the dominant nitrogen fertilizer, and sulfur is used in phosphate fertilizers and chemicals. So nearly half of all traded urea and sulfur are tied to Gulf exports. So this can't be pipeline like oil. And the only other option is through the Red Sea, which faces its own potential threats there as well. But becoming more broad-based on this next chart, we see how these products literally touch everything that we use on a daily basis. So all the commodities need to be transported in some capacity, so they're not only subject to potential production shocks, which we've seen historically, but we're also experiencing now that they can face logistical shocks. So the numerous commodities on the left impact in some capacity the end products on the right. And the percentages shown just how much of these commodities come out of the Middle East. And a point to make here is that even when this choke point is normalized, which could be weeks away, months away, risks still remain. For example, there's 8 to 10 million barrels per day shut in by the Middle East oil producers as their storage tanks are full, and they cannot get their oil and LNG out. So shut-in production takes time to bring back. It certainly isn't immediate in any way. And this doesn't account for a significant amount of oil and gas infrastructure that's been destroyed in the Middle East, and that will restrict output, if not for months, and potentially for years. And now that there is a U.S. naval blockade in place, it's doubtful any Iranian crude oil will be getting out, which was reportedly 1.5 to 2 million barrels per day, even over the past month. There's been conflict. So the result will be a new strategic just-in-case hoarding mentality that will commence for any commodity that can be stored, and it will be highly price supportive through the entire commodity complex. And what this means is it's very inflationary and positive for all impacted commodities and related companies. And this highlights the importance of the U.S. energy complex and our lack of reliance on much of what's going on in the Middle East. And so these assets are now carrying somewhat of what we call a security premium. On the next chart, we're switching gears a little bit. We've witnessed a rotation in the markets somewhat that began well before the Iranian conflict. And another positive for the commodity complex is the relatively recent intersection of technology and commodities like we've never seen before. So you've seen massive CapEx by the hyperscalers and something new and largely routed toward powering data centers, including all the materials and components that go along with that. So power is and will remain the gatekeeper to AI's advancement. So, realms that we have exposure to, such as gas turbines, solar generation, power storage, nuclear, independent power producers, utilities, all fall into this significant growth sector now. And as this chart shows, the picks and shovels, if you will, of AI, the energy and the infrastructure equities have materially outpaced the tech companies themselves. So whatever your opinion is on AI, it has had a dramatic impact on power-related firms in all forms, so gas, solar, storage, and nuclear, which will continue as long as AI data center needs grow. On this next chart, we're often asked whether the commodity moves to date have been made through these dramatic moves that we've shown. And I feel this chart visually answers that question pretty well. Materials and energy are decisively underrepresented in the broad indices, and this chart shows the extent of that. The environment for select commodities and real assets, those that are more scarce and strategic, has decisively changed. And our general call is that hard assets, natural resources will outperform financial assets over the foreseeable future. And the reasons are now structural. So deglobalization, resource and mineral nationalism, resource hoarding, and a fracturing between East and West, and even in some respects, West and West. Examples of U.S. and NATO members not coming to assist with the Iranian situation. Tariffs have been a big point of contention. So it's really becoming somewhat of a Hunger Games mentality, which is becoming much more pervasive with regard to commodities, whereby these prior allegiances have been put into question. And with that, each country has to think about how they best position themselves if these prior alliances are no longer reliable. This next chart, again, kind of going back to our name, stuff over paper, this provides context to paper assets. These charts show the publicly traded tech and PE firms and their recent performance. And you're seeing real cracks on the paper side, predominantly in those private equity firms that are involved in private credit, mainly via software loans, the banking groups, and then software companies themselves. And this isn't really just a pile on financial firms' problems, but it's to highlight a structural shift in real asset market rotation that we feel, again, is in the first few innings. With that, I'll pass it over to Steve on why this is a sustainable path.
Thanks, Darren. Yeah, there's been a lot of talk about the CapEx of the hyperscalers. Darren just had mentioned earlier and showed the chart, and this chart just shows just the size and scale of some of this CapEx is approaching historical levels, things we saw in the early 2000s. But this trend has really been in place for decades, however, with spending on intellectual property has outweighed spending on plant and equipment for some time. In fact, this very fact forms some of the basis for why we think real assets will perform over time. This tech CapEx boom really is part of a larger global CapEx cycle that we believe will play out over decades. In fact, Jeff Curry, ex of Goldman Sachs, astutely points out that what were called commodity super cycles in the past were really just big CapEx cycles. And the way that these CapEx cycles play out in commodities can be seen by looking at two of the most critical commodities, oil and copper. Arjun Murthy, also ex of Goldman Sachs, put together this chart which shows the CapEx cycle as it played out in the oil market during the period from 2002 to 2014. A period encompassing the boom and the bust cycle in oil here in the U.S. He termed this cycle the quadrilateral of death. And let me explain this a little bit. In short, it is spending. What happened is that spending increases as prices rise, which leads to a flattening of return. And we saw that firms continued to spend even as those returns. Driving returns lower and lower, and as we saw, this prices rose and rose, and CapEx spending rose right along with it. But ultimately, what we saw was the incremental returns on that additional dollar of CapEx fell quite precipitously. And in fact, what's interesting about this chart, as you can see, is that the returns on spending at $100 oil were pretty much the same as returns on spending at $20 oil. So that just shows that what's also important to note about this chart too is that incremental spending continued even after the price had already turned down. And also what's also instructive too is that the spending by producers during the recent price spikes has not deviated. They remember how that spending came back to bite them in its most recent history. We can also see this CapEx cycle playing out in copper as well. If we look at CapEx spending over what would term the commodity super cycle, as you can see, the price of copper rallied during that period, and CapEx rallied quite sharply as well. However, that spending fell quite precipitously as the super cycle ended. And what's interesting about this chart is that the price of copper of late has continued to rally to all-time highs, but CapEx has failed to keep pace. So this chart in particular would rebut those that would say that the copper price has peaked, given that we haven't seen a commensurate peak in CapEx. And this could be shown in platinum as well. The prices of platinum is almost tripled over the last 18 months, but as you can see, industry CapEx has remained flat to falling. And this chart just shows that CapEx is lagging over the broader mining industry as a whole. So again, CapEx is failing to keep up with the broader price increases. And it's not any great mystery, in particular in the mining side, why that's happening. And this is a slide that we showed from the first webinar. I always say I'd show this slide in every webinar because it's really important to understand what's going on the mining side. And this just shows the number of years it takes to bring a greenfield mine into production. As you can see, the average is around 28 years. And there's a mine in Arizona called Resolution Mine, and that mine, just to get it back in, is this pretty substantial mine, and just to get that mine back in production is estimated will take around 8 to 10 years. So again, the greenfield mine production and the CapEx that we talked about earlier for copper in particular is not necessarily going to be a solution. Some of the AI development that Darren had spoken of earlier has caused some concern in the markets of late, particularly on the software side. This chart just shows the S&P 500 metals index against the S&P 500 software index. And this divergence has led to another term in the financial lexicon, FOBO, and that's fear of becoming obsolete. And this term also fits with those industry termed halo. It's another term that's come up as of late, and that's refers to those with heavy assets, low obsolescence. What's interesting is that both of these terms would indicate that as investors are becoming highly receptive to the fact that the industries that we follow and that we're talking about are hardly not only highly critical to the global economy, but also highly undercapitalized. However, the CapEx spending by the hyperscalers is skewing people's views on corporate spending in particular. And in fact, this is the chart just showing how they pulled a number of CIOs, and this was their general view was that they would like this to be less spending on CapEx, and our only point would be that clearly they're not talking to the industries and the folks in the industries that we're talking about, because the CapEx cycle in the industries that we cover continues to be flattish, even in energy as such. And we firmly believe the underpinnings for a shift towards hard assets remains firmly intact. Now, the outperformance of stuff over paper is a secular shift, as Darren mentioned, and we feel like this will play out over many years. However, we know that secular shifts are often accompanied by high degrees of volatility, and this is true. This is a chart just showing what we feel is the secular bottom in interest rates and the associated volatility. As you can see, volatility tended to pick up as when we saw that shift occur. And this chart is just a chart of the long-term chart of gold, and it shows much of the same thing. As we see this turn occur, and the market tends to get more volatile. Now, part of this volatility is due to the relative size of some of these markets relative to the other parts of the capital market. And here, this chart just I think does a good job of showing just how small the commodity markets are relative to the other larger parts of the capital markets, in particular U.S. equities. And again, this just illustrates that a relatively small shift in capital flows into any of these markets caused an outsized response. And this capital imbalance can also be shown in this chart. This just looks at some of the market capitalizations of some of the largest miners. And for example, BHP Billiton has a $195 billion market cap. And, by contrast, OpenAI is a private market capitalization of around 850 billion. So roughly 4 times as large. And this transition period, Darren had mentioned it earlier, and we talked about it in the first webinar, is this battle between East and West, and Darren pointed out too, is now it's increasingly becoming West versus West. We're seeing this played out in some of the relative pricing and some of the commodities that we follow. And here's a chart of just the aluminum premium. This is the aluminum premium of Midwest delivered aluminum relative to the price of the London metals contract. As you can see, part of this is due to tariffs that have been in place, that put into place last year, but much of the premium as of late is due to simply hoarding. What gives us a good deal of confidence that this shift is secular and not nature, not just a China-specific story, is this chart in particular. Here we have a chart of some of the most China-centric commodities. And these would be copper, coal, and iron ore. And we see that the most China-centric commodities, in particular iron ore and coal, have wildly lagged, indicating that there's more to this move than just a China growth story. And with that, I'll turn it back over to Darren, and he can tell us why investors need to get involved.
Thanks, Steve. So circling back, we believe we're in the initial stages of one of the most important secular investment shifts in decades. Again, from a tech-led new economy to a resource-led old economy standpoint. And as this chart shows, there's a lot of ground to be made up just on the energy side relative to where IT is in terms of its percentage of the S&P 500. So what this means is necessitating reallocations all across the investment spectrum, consuming not only public equity markets, but debt markets and private equity. Overall, there's been significant underinvestment, as Steve said, in many of these industries over the past decade, as the service industries rose to the top and we outsourced much of our production to other countries. This has now set up structural supply tightness and is hitting when strategic hoarding of stockpiles will put further strain on supplies, driving prices higher. And this is most apparent in upstream oil and gas, refining, and mining. But includes many more commodity-related sectors. This underinvestment means supply just cannot respond quickly to price signals, creating a multi-year window where modest demand surprises translates into outsized price moves. So an emphasis on deglobalization, decoupling, and de-dollarization is amplifying the speed at which a move toward commodities and resources is happening. And all three trends tend to be commodity positive because they add structural volume demand in some areas and structural friction or premia almost everywhere else. My last slide, you see that financial assets are really the best hedge for geopolitical risk, US dollar weakness, and the structurally inflationary world, as well as the secular supply-demand changes discussed earlier. And as we're seeing, especially at the pump or through fuel surcharges, war is highly inflationary. As this chart on the left depicts, while oil is benefiting from geopolitical strife, bonds on the right are doing the exact opposite and not fulfilling their historic role as yields have risen since the start of this conflict. As this chart depicts, investors need to be strategic about how to prudently get involved. And as such, we advocate an actively managed portfolio, which will give them intelligent exposure through the bigger cycle, not just a passive ETF approach. And the reason we believe that active versus indexed or passive is the better structure is that these sectors are not immune from the hype, contagion, and disinformation associated with other sectors. Many factors need to be actively considered with commodities, including futures curve and roll yield management, dynamic tilts, the use of optionality and structure, tactical risk, and customization to objectives, which are all factors to think about when constructing and modifying a commodity and resource portfolio. So again, an active management strategy is really ideal or prudent when it comes to commodity and real assets specifically. And to close up the webinar, I'll pass it right back to Steve.
Thanks, Darren. No, SOP Advisors is there to mention we have over 50 years of combined experience in real assets and commodity-related equities. We build managed, specialized portfolios using equities and ETFs with full transparency and liquidity on the Schwab and other platforms. So thank you for spending the time, and look forward to speaking with you soon with another webinar.